Welcome to the Note Investor Podcast. We'll guide you through the ups and downs of note investing and teach you all about the nitty-gritty details of the business that other people won't talk about. Your host, Dan Deppen, is a former aerospace engineer and product manager who transitioned away from cubicle life to full-time note investing in 2018. Our website is www.fusionnotes.com, where you can subscribe to this podcast, comment, and find links to other information on note investing.
Hi, everyone. Welcome to the Note Investor Podcast. I'm your host, Dan Deppen, and today I'm joined by Max Bailey from Call the Underwriter to talk about seller finance and originating notes. So, Max, how you doing?
Doing well, Dan. Thank you for having me. How are you?
Good. Yeah, no, welcome, and thanks for coming on. I really appreciate it. So, seller finance is something that it's an area that I get a lot of questions about. There's a lot of interest in it, and I've done a few of them myself, but I'm no means the expert. So it's great to have you on to kind of fill us all in on, how we should be doing this.
Thank you. Appreciate it. Well, and I'm by no means an expert either. I think this is like medical stuff. We're practicing, and I think everybody is feeding off one another, and we probably keep getting sharper as we go. There's a whole lot of folks in this industry now, and everybody's sort of sharing tips and techniques, and we're all making each other sharper as we go.
Yeah, that's kind of how note investing works in general for me. Like I think I'm learning new stuff every day, even in the core part of the business. So maybe give us like an overview of kind of, who you are and Call the Underwriter is and what you guys do.
Yeah, absolutely. So I'm sort of I'm sort of new in the Call the Underwriter place. For those of you who don't know yet, after working with Russ and Elsie for a period of time, we asked them to buy the business, and we finally put something together and got that done. So the business sale is complete. Russ and I are still friends, and so we'll certainly throw work toward each other. And from time to time, I'm still going to have Russ do podcasts and informational education pieces. That's really his strong suit. And so I think our clients will still continue to see him as often as I possibly can make that happen. But from day-to-day operations now, he is moving into some other things. He wants to do some vacant land seller finance, and he wants to move out and do some other things himself. And so Michelle and I, my wife, are happy to have bought this business, and we're going to take off right where Russ and Elsie left. We're not changing anything a whole lot other than just a little bit of automation and a few procedural things in terms of how lenders will submit their packages to us and that kind of thing. Mm-hmm. And by way of background, Michelle and I have been involved in real estate off and on since about 1990. I started as a realtor, just working in a brokerage selling places, and that led me into buying my own properties. Throughout the last 25 years, I worked full-time as well as a firefighter paramedic, and the career of firefighting afforded me a lot of time off. I was off during the daytime about 5 days a week for 25 years and still had the income to fall back on from the firefighting job. And so throughout those years, I was buying and maintaining and managing rental properties. And I finished a finance degree as well. And so, did quite a bit over the years with finance lending, not so much being the lender to other people, but using my understanding of financing to work the most favorable deals I could to leverage myself into as many properties as possible. And so most of my background was from the rental and real estate ownership standpoint. And now this sort of rounds us out because I'm working on the other side of the table. And now I'm the one helping all of these people put their deals together and kind of seeing everything from the opposite side.
That's cool. So did you have to then get like licensed as a mortgage loan originator at some point in there, or how does that work?
Yeah, I've done all the training, got all the same knowledge, but the way mortgage loan originating works is you have to hang your shingle, so to speak, with a brokerage, and they expect you to be originating loans. And so I'm using that knowledge in this business, but I'm not actually originating any loans. And so, as a private business, to underwrite, we couldn't just put our NMLS number out there unless it's underneath a brokerage. So I'm still kind of feeling that out to see. I may still put it underneath a brokerage and advertise that, but really my intent is to underwrite these loan packages for all of our lenders who are the loan originators.
Oh, I got it. Yeah, that makes sense. I didn't think about it that way because I've used you guys before, but when I'm doing that, I'm actually the originator in that
Exactly.
case.
Yep. Yep.
Gotcha.
And so, as the underwriter, in the documentation, there's sort of that arm's length arrangement they talk about in business finance, where really the loan originator shouldn't be underwriting their own work. And so, in this case, you're exactly right. All of you out there are the loan originators, and I'm in that virtual back room down the hall where underwriters sit. And after you've originated the loan, that package comes down to us. And then we're that neutral third party that is vetting this borrower from an ability to pay standpoint, and really acting as your insurance policy that there's no predatory lending going on, and that this borrower will meet all of the Dodd-Frank requirements spelled out in ability to repay legislation.
And what are some of those requirements that have to be met that lenders might not be familiar with? Like I know of like Dodd-Frank kind of generally, but like what kind of things are you looking for to make sure that the loan is compliant?
Yeah, there's really 8 different factors that Dodd-Frank says we're required to take into consideration when vetting a borrower. And those deal with, 2-year work history, adequate income, certainly a good hard look at their credit, a certain amount to deal with the nature of the loan, whether it meets all the parameters for a legal loan. And so what we do is we take in, once the lender, who would be you, once the lender takes that application and collects all of the borrower's income documentation, they then submit that to us, and we dive in and start vetting their income against the DTI requirement to ensure that they meet debt to income ratio standards, and really just vetting this thing to be sure that they meet the residual income requirement. Each state has a different residual income requirement, which is all factored based on what state they're in and what the taxes in that state look like and what cost of living index for that state is. And so we punch all of this stuff in, and when we're done, we're able to spit out a yay or a nay on whether this individual is going to meet Dodd-Frank's compliance requirements. And the purpose of that is that down the road, if this borrower, let's say, has a negative life event and defaults on this loan, then they may go get an attorney and say, I want to challenge, I want to challenge the legitimacy of this lien because this surprised me. I never knew it was going to be that much. I'm not prepared to pay that much. I think this was a predatory loan. Well, our process creates this documented paper trail showing that we have followed best practices in the underwriting industry, and that allows that lender, if the need be, heaven forbid, but to go to court and on the rebuttable presumption, which is typically how they challenge one of these. In other words, making the presumption that this loan was a bad loan and that this individual never could pay, we're able to submit all of the documentation showing that, well, no, this loan meets Dodd-Frank requirements. We did all of the things in our standard practice for vetting this individual, and we're not putting people into loans that the factors say they're not qualified to pay.
That's very cool. Yeah. Yeah. Cause as a lender, I'm always just happy when I'm selling an REO if I find somebody who wants to buy it. I'm not really good at scrubbing borrowers because for me as a note investor, I'm typically buying notes that have already been originated. So I'm not doing that most of the time. And really, like when I'm buying non-performing notes, if I want to buy the non-performing notes, I kind of already know this borrower is delinquent at some point. I know their credit is garbage. And so I'm not generally in the mode of vetting the borrower, but when you're originating on the other side, it's a completely different animal.
Yeah, it is. Different for two reasons. Number one, obviously the liability issue, right? Because you're actually now the one putting your name down as the LO. You're the loan originator, and if it's a non-compliant loan, you're liable. And then number two, because you're the loan originator on a non-compliant loan, it could affect your marketability of that note in the future as well. And then, thirdly, and this is important, and I think even though, this is a business and everybody's trying to make money, I like to not ever forget about the fact either that there's the human factor in this, right? The third piece of this is we're talking about somebody who could potentially default and lose their owner-occupied home for them and their family. And the intent behind Dodd-Frank and all of the ability to repay legislation, the intent is that we never have another mortgage bubble burst where half of the country loses their homes due to predatory lending. And so, from my standpoint, I try to sort of be that neutral third party that's looking at the interests of both. I'm looking at to make sure we're not putting in a borrower in a position that they really shouldn't be in that could end up costing them their home. And then on the other hand, because I'm paid and I'm working for the lender, I'm also looking at it from a standpoint of if I give this blessing and say this family is good to go in here, you're going to take that to the bank in the event that they do default and this is challenged. And so I'm working with your best interest in mind as well.
Right, because as you said, you're kind of providing a sort of insurance policy.
Absolutely.
For the lender. Yeah, and you don't want them coming back. So what are the limits, like as an individual or an LLC, on how many loans you can originate? I always get confused on this myself when I hear different things at different times. I think what I heard in the past was you can do like 3 in a year or something like that. But
yeah, for the purposes of what most note investors are doing now, they can do up to 5 in a year without getting into the realm of being considered a commercial residential loan originator. But I can tell you from experience, there's investors all over the country that are doing far more than that. Even they're getting around that, and what they're doing is, and I'm not necessarily saying it's good, bad, or indifferent. I'm not an attorney, and I'm not going to give that kind of advice. But I can tell you that it's happening all over the country, and that is that lenders are feeling comfortable originating a certain number of these under one entity, one LLC, and then 3 months later originating more under another LLC. And I don't know that there's any case law precedent or anything on that, but people are doing far more than 5 per year in the seller finance world.
Yeah, I'll have to have him back on. But at one point I had Bob Repass on where he was talking about the Seller Finance Coalition. They were trying to get those rules changed where it was more clear, where I think they were going for like 24 or something like that. And then that would just make life a lot easier.
Yeah, it sure would. Absolutely. And I think, the seller finance in 2019, I think, was around $30 billion, somewhere between 25 and $30 billion. So, this is a bigger industry than a lot of people probably think that it is. And so there's no doubt in my mind, it's like a snowball rolling down a hill. It's just gaining more momentum every year. This is not going away. So it's only going to keep getting bigger. And I think there's quite a few really sharp people that are taking a legislative interest in this. And so, yeah, I think in the future, it probably is going to be maybe massaged into something that's a little bit more consistent, a little bit more user-friendly for seller financiers, and a little bit easier to understand. Right now, a lot of it's still all convoluted and untested.
Yeah, definitely. Because I know, especially now with the low interest rate environment, I mean, there are a lot of deals that banks just won't lend
Yep.
against with
Yep.
interest rates low. I mean, if it's a smaller dollar amount loan, they're just not gonna bother. So there's this big underserved part of the market through seller finance
There
comes in.
is,
That's
for
how it
sure.
gets
And
to 30 billion pretty quick.
there is, and in that underserved population, I guess kind of the way I look at it is there's kind of a fraction within a fraction. If this many people the banks are saying no to, well, probably half of that number we need to say no to as well. But
Mhm.
then there's a sweet spot in the middle there where there are people that really make ideal borrowers for seller finance lenders. And that's the group that we're looking for. And so one of the big things I want to do this year is really help educate the lenders on how to vet and screen these borrowers on the front end so that we can sort of sift uh, that little group of people that we're wanting, and not
Mhm.
expend too much time or energy or build up the hopes of the borrowers that really aren't prepared. And so a lot of my focus this year is on trying to create some repeatable screening processes and provide some investor information out there that enables them to do a real good, consistent pre-screen of their borrowers, so that when packages come to us, ideally we get our ratios up, to where when packages come to us, 90% of them are they're going to be a go. And we're
Mhm.
doing that a couple of different ways. I've created a bunch of information that I'm sending out to every new investor right now, and requesting that they utilize it in screening their borrowers. And then the other thing that I'm going to start talking up more as well is that borrowers get onto our website, or that lenders get onto our website under the investors tab. And there's a residual income calculator. Run your borrower scenario through that residual income calculator. And if that tells you that they're likely to meet residual income, well, then they're very likely to meet ATR requirements in general. And so if every lender, at least until they get really comfortable looking at a borrower and saying, this guy's got a real chance or this guy doesn't, if they would just start that process of going to the website and run their borrower through that residual income calculator, well, ones that aren't even close, then they can just walk away from, and we'll never even see them. That enables us to be more efficient as the volume increases for everybody else, so that we're not spending days screening and trying to work a miracle on somebody that never should have come to us to begin with. And it's certainly better for the borrower because we don't get their hopes up to that degree. And it's better for the lender because he doesn't, have near as much of that downtime of taking an application, selecting one, maybe taking the property off the market, running it all to us. We work on it for a week only to say there's just no way, we can't do this. And then they have to burst that poor family's bubble and start all over again.
Yeah, because there's a lot of churn in there. Because I've done that before. I mean, I've done, I think I've done a handful of these like in the past year or so. But yeah, I've had some where I throw the package over to the borrower and say, "Here, go fill all this out." It's where was that? Was that the 1003 form?
Yeah, the
And there's a lot
1003.
of stuff in there. They fill all that out, and then it's like, well, okay, you're missing this and that, and you get that from them, and then you find out it's not going to work. Yeah, it's a lot of churn on everybody. Yeah, that would be nice if
Yep.
it was easier that would help me out a lot. Yeah, if I had an easy way just to kind of pre-screen, I could just ask them some simple questions and I would have an idea
Yes.
if it's going to follow through or not. Because for me as a note investor, like I said, I don't originate that many of these. I don't know what the
Yep.
Dodd-Frank requirements
Yes.
are. That's why, throw it over to you guys to let
Yes.
me know. But yeah, pre-screening option would make life a lot easier, because I do run into that issue where what I usually end up doing is I leave my ads out there. I don't completely take it off the market. But then as people hit me, I go, well, we're kind of under contract. I'll let you know.
Yep.
And then if it falls through, then you're like running back to chase down
Yep.
all these other people. And it's time consuming. Yeah.
It is very much so. And again, I'm trying to look at this from both sides as well, right? So I work for the lender, so I want to help you guys become as efficient as possible. But again, also, it's heartbreaking to me when a borrower gets all excited and is sort of made to feel from the lender that, hey, you know, congratulations, this is going to be great. Let's fill out your application, send it in. And then, you know, for a week, I have to grind and try to turn it into a miracle, only to finally get a hold of the lender and say, man, there's just no way. There's just no way. And then that poor lender has to go back to that borrowing family that got their hopes up and say, sorry, you know, there were some things that we didn't know that we've now figured out, and sorry, this just isn't going to fly. We can, as a team, we can do a better job of uncovering those, you know, those things that will be deal breakers, those red flags. We can uncover those real early in the process and not get these people's hopes up to that degree, and really save us all a lot of time and energy. One of the things that I'm in the process of doing right now, I added an investor's link on our website. So now I've got a borrower's link where you would send your borrower to, and that link is going to give them all the information they need, as well as all of the documents that they would need to submit to become a loan package. And then I've created an investors tab, and I'm in the process of filling that with all of the tools and materials that I'm going to recommend that the lenders use to pre-screen their borrowers. And so, you know, in the meantime, I do it all day, every day. I'm certainly happy to entertain just an email with questions or a phone call as well. What I typically do if somebody calls me or emails me, I have a standard package that I send them out. So I just send it directly to them and say, you know, read all this and check this out. This really will answer everything that you want to know before you screen your borrower. And, you know, over a period of time of doing this, I think then we're all going to sharpen ourselves up, and the percentage of packages that have to be rejected, I think, are going to go way down.
Yeah, that would be nice. I know as a lender too, it's always disappointing, like when, you know, the borrower's ready to go. And for me, at least in my model, when I get REOs, I like to just try to get rid of them as fast as I can. So it's also a bummer, because it's like, okay, now my REO hasn't transformed into a note as fast as I thought. Now I got to go back and find somebody else, and this may take a little while.
Yeah. Yeah. No, you're right. And, you know, a few of them that we get in, it seems like we get them in and we have to sit on them for days and days and days, because the lender can't get them to produce the documents that are required, you know. And so we can sharpen that up a lot on the front end as well, so that a package isn't even submitted until that lender says, I know that given the type of income you're claiming, these will be the documents that are required. And it doesn't even go from you to me until you've gotten those documents from that borrower. That will save everybody a ton of effort.
Yeah, because I've had a hard time, like, you know, some of the borrowers, you know, you ask them to submit to fill out the packet, and they're like, well, I don't have a computer. It's like, I don't have a printer. And I've had them like fill things out and try to take pictures with their phone, and like they're all blurry, like you can't even read it. It's like, well, now we got to be able to get the information submitted before I can really. Or they fill it out like incompletely, like like I've had them send it back missing a bunch of stuff, and I go ask them, okay, fill in all this stuff, and then they fill in like some of it but not all of it, and it's like, come on, man, let's.
Yeah, absolutely. You know, and on the website we've got those fillable forms. You know, my thinking is even that lenders may. Can you still see me, Dan?
Yeah, I got you. Yeah.
Oh, okay. I got something popped up on my screen here, so you disappeared. There we go.
Oh, no, I got you.
Pardon the interruption. Anyhow, you know, on our website under the borrowers tab, we've got those fillable applications and forms. And I think maybe in some cases, lenders might just want to create a system where they're literally sitting down at a computer in their office with the borrowers and working that application together. It's an educational process, just like you would if you went to a bank, And
Yeah.
I see on the lenders that have refined a consistent process, their packages are coming in far cleaner than the ones that appear to just tell the borrower, go find the 1003 and get it filled out and send it into the underwriter and we'll see what happens. And boy, most of the time, those are the ones where we end up producing a needs list this long and have to shoot it back out to the lender, and say, well, this is going to be on the shelf, collecting dust until you can get this stuff done. And so, yeah, I think a lot of it comes down to that, how that lender sits down with the borrowers and works that submission package together. And when
Yeah,
that's
in
done,
a
they're
perfect
clean.
world, I don't know if you can do it yet through your website. It may not work, but would be great too. So there's a solution where the borrower could do it on their phone. Because I found everybody has a phone. So when I need like just in general doc signed, I'll use like RSign or DocuSign to send stuff to people so they can sign. If they can sign something from their phone, that always goes a lot
Yep.
smoother, I find. But
Yeah. That's a great point. And again, that's the beauty of this kind of a community where we're all kind of freelancing and we're inventing this machine as we go. Inevitably, we will continue to evolve our processes to accommodate the needs of the borrowers out there as well, because this is seller finance for a reason, right? It doesn't fit all of the rigid strictures of Freddie Mac and Fannie Mae. And so given the nature of our demographic, we have to remain a little bit more flexible, and there's got to be a little bit more discretion put into what we do.
yeah, for sure. Yeah, because a lot of folks are not tech savvy. Whenever I've asked anybody to scan anything, that's always troublesome. And I know just
Yep.
getting, other docs signed, a lot of times I end up just sending. Actually, I've done that for some of my seller finance, where when we got to the end, where after we knew they were compliant, usually end up just sending a mobile notary with all the docs and have them sign it right there
Yep.
and then take
Yep.
it back. Yeah, the easier you can make it,
Yeah, for sure.
better.
Well, I could certainly rattle off a little laundry list of kind of just the black and white things anyway, that if a lender will keep these in mind, it's going to clean up the process a whole lot.
Hmm.
Probably the number one thing we find on our end that stalls the process is the 2-year work history. These borrowers, even though this is more flexible than Fannie Mae and Freddie Mac, they still need to demonstrate a 2-year income history. And so the number one thing by far that stalls our packages is they take a 1003 and they fill it out and it gets sent to us and we open it up, and let's say they're a W-2 wage earner and we see that they've been on their current job for 9 months and we don't see anything before that. We can't calculate ability to repay off of such a fractioned income period. And so we expend a ton of time flagging those kind and then writing back saying we're going to need a 2-year work history on this individual. So if lenders on the front end just knew right off the bat when you're screening your borrowers to say, will you be able to provide a 2-year work history? Did you have adequate income all through 2019? And do you have adequate income all now through 2020? When you get the ones that can't come anywhere close to providing a 2-year income history, they're not going to make it.
What if they're self-employed? Like, what if they don't have a W-2, but they're like a small business owner or something?
They're actually easier. Self-employed is easy. We do them all the time. Just did one this morning. And they have really an option. They can either provide us previous year's tax return, or they can provide us 12 months of the most current bank deposits. And then we run a figure on those gross deposits. We subtract out 25% for business overhead, and we run them on 75% of their gross. Super easy to do. So same thing, self-employed, no problem. You just find out, have you been self-employed for the last 2 years? If they have, then you tell them, okay, here's what we need from you. Ideally, we need both so that we can give you the best run for your money. You'd tell them, okay, we're going to need last year's tax return, and we're going to need your most current 12 bank deposits. You get that on a self-employed borrower, we're golden.
That's cool.
Yep. Piece of cake, and those run quick and easy. So the W-2 wage earners, honestly, are far harder, because if they're job hopping, then you're talking, we need on a wage earner, we need the two most current pay stubs, and we need the previous year's W-2. Well, if they've had 3 or 4 jobs in a 2-year period, that's a nightmare to try to track down all that stuff and try to construct a 2-year income history.
Oh, do they care if they're working like in the same profession?
Yes, that's ideal.
Years,
That's really what we want, is same profession. Right, exactly. It's not going to kill a person if, let's say, they're, a retail worker and they worked at Walmart for 5 years, but then last year they quit Walmart and they moved to Target, and so this year they're with Target. No problem. Then all we need again is paint us that 2-year picture that says they've still been doing the same stuff. They just took an upgrade is all. So, you show us your W-2 from Walmart from 2019 and a couple of those pay stubs, and you show us your 2 newest pay stubs now from Target, and we work it from there. The big caveat is gaps. When they've got a big gap in employment, you can know ahead of time as a lender that if they're going to fly, at the very least, we're going to have to condition a letter of explanation for that gap. So again, your pre-screening could look like, you're taking their history from them and you're saying, have you worked for 24 months steady? And they tell you, well, no, I worked last year, but then I had a 4-month gap where I didn't work and now I'm back to working again. Well, then you could know as a lender to say, okay, that's going to be flagged by the underwriter immediately. So explain your gap. What did you do? Why was that gap there? Most people have a great explanation. Maybe it was COVID. Maybe it was high risk pregnancy and she couldn't work because of that. Well, it doesn't matter whatever the issue is, but as a lender that you can get ahead of this rather than having it lag for days. You can get that letter of explanation right in there right then that covers that gap in employment. And when the package comes into us, that gap in employment's already explained. And then most of the time, that enables us to connect the dots, so to speak. But the ones that really hold us up is when they put down their work history, that shows their current job and they've been on it for 4 months and there's nothing after that. Those sometimes just languish in the inbox for weeks while we're waiting.
They were in prison for the 5 years before that or something.
Right. Yeah. And then the other big one is that group of people, and you see it quite a bit in seller finance. There's a reason, right? Let's say there's a reason why most of our borrowers in seller finance didn't go with a traditional lender, right? And get a regular Fannie Mae, Freddie Mac loan. There's a reason. Well, one of the most common reasons for that is this group of people that are not using banks. So they're handymen under the table and they have no method of documenting their income. Well, if they have no method of documenting their income, this could be drug money from a cartel. We can't use it either. And so, as a lender, you want to be savvy enough to explain to your borrowers long before they ever fill out a 1003, I've got to be able to construct a 2-year work history for you, and you have to have some method of reasonably reliable third-party records that prove what you're telling us. So if you're a handyman, no problem, but are you putting it in a bank? Do you have deposits? Do you have invoices that show that you invoiced your work and then copies of the checks where they sent them back to you? No matter how you do it, you've got to be able to prove your income somehow. And so when you see one of those borrowers that just can't, that's one that should never even come in a submission package.
Yeah, and in those cases too, they probably weren't paying taxes, so they might enjoy that for a while, but there's always a consequence for that, even if you don't. If you want to be, because there are people like that out there who are kind of like, I consider them like kind of off the grid, but there's a price you pay, when you want to.
Yeah, and that's
else
to
within
me.
the financial system.
Yeah. To me, that's what differentiates that stratification layer we were talking about earlier. Here's the group that the banks want. And then just below them is this group that the banks won't quite take, but we want. And then below that is that group that you want to be able to pre-screen and say, this person just cannot meet requirements, period. And that would be that group that can't document their income. The group that hasn't had the same job for 6 weeks in 4 years. So they have, so many starts and stops on their jobs that you can't even connect the dots when you put it together. Well, if you can't, we can't. Or that group, the other one would be that group that is, when you're asking them questions in the pre-screening, they've got current judgments against them. They are in the middle of a bankruptcy right now that hasn't yet been discharged. There's just those types as well. And it's amazing how many of those still squeak by and they show up on our desk, and we have to put on our investigator hat and start trying to paint the picture and connect the dots, only to find out that, oh no, this one never should have come through.
Yeah. Are there a serial BK filer or something like that?
Yes.
So,
Yeah, exactly.
very cool. Well, Maxwell, thanks so much for coming on. I really appreciate it. We'll have to do this more at some point, especially as I hopefully end up doing more of these in the coming year and get kind of deeper into the seller finance world. So
yeah, absolutely. And in the future, I'd be happy to do one, if nothing else, where we build some visual charts or something that really demonstrate the tools that a lender could use to pre-screen a borrower. We could do ones where we really break down income. Income seems to be the big one that trips everybody up on how do we vet borrowers? How do we know good income and bad income? And so, it just education, I guess, on my end is where I'm thinking where we can help this community the most is on the education side.
yeah, and I'm definitely happy to help you distribute that. As you want to put those together, you really want to do a webinar or.
Yeah.
I've got a pretty decent sized list of folks who are into this. Yeah, I'm happy to push that out
For
to
sure.
them because I know people are looking for the info. So
Yeah,
cool.
Absolutely.
All right.
Okay.
Thanks a lot. Appreciate it.
Likewise. Good talking, Dan. Appreciate it.